thank you all for joining us today. My name is Kyle Paterson. I'm with Part-Time CFO Services, and I'm joined here with Zach and Todd from Coface. I will get into handing this over to both of them here in a second, but just before I do, I'm going to share a little bit of background on Part-Time CFO Services and just some context to why we're having this conversation today. So here is our first logo. So Part-Time CFO Services provides the complete accounting department solution to organizations. We started out as a CFO firm, but over time, we've actually now come to offer the full accounting department solution. And clients reach out to us for a lot of different reasons, but sometimes and most frequently, it's for big strategy level discussions like this, where it's important to provide forecast predictability and proper reporting to help drive through these turbulent times. And there's no doubt that we're currently in a time that has higher severity of turbulence than normal times of calm trade and international relation. Just so you can see this too, I always like to show that we are a great place to work certified company. We give back a lot in the community, but it's just nice to know that the people who do work here like working here. Now, why are we having this conversation today? I mean, when we first reached out to Zach and Todd for this, things were just starting to materialize, and I actually thought there was a potential probability that we'd come on this call today and everything would be steady and firm and calm again. But as we've seen, things have actually just gotten significantly less predictable and more severe on the default risk side. So this is from Moody's, and this is showing the publicly listed firms that their default risk is increasing, and it's at the highest it's been since the financial collapse. So risk of default by your buyers and suppliers is higher than it's been. At the same time, and I think this might be difficult to see depending on your size of screen, Moody's also just does a severity warning risk assessment as well. And I get that these are US firms, but for companies that are under $1 billion in revenue, there's 52% now showing at severe risk of potential default, and their situation's actually deteriorating further. And that kind of brings us into where we are today. So setting context here, when we think about where to listen from in this conversation or where to approach it from is often we're sitting in leadership meetings or board meetings where talking about sales, we're talking about key performance metrics or targets, but we're not necessarily auditing the quality of our supply chain. We're not necessarily auditing the risk of our buyer network. So in this conversation, just to start us off, thinking for yourself, do you have vendor or supplier concentration risk? If a key supplier ceases operations, is there a cascading impact that would happen throughout your business? Do you have key buyers, and what would happen if they defaulted in your buying cycle? And is it easy to replace those buyers? If you have a buyer making 30-40% of your purchasing, what happens if they disappear? So with that, I'm very happy to introduce Zach here and Todd as well. So Zach has been with Coface for 5 years, 4 in the current role where he's the head of risk for Coface North America. And he started his career as a fast-growing alternative lender and has worked across Canada, the US, and the UK. He holds both his CFA and his FRM designations and was named a top risk underwriter by the Receivables Institute in Canada in 2023. And Todd Pickett, he's been with Coface since 1997. I've actually known Todd for a long time, and he's a really great person too. And he was promoted National Sales Manager in 2015 and most recently ranked in the top 10 for North American sales and #1 in Canada. He's passionate about personal growth and is dedicated student of Stoicism. And with that, I'm very happy to hand this over to Todd, who's just going to give you a bit more background on Coface.
Yeah, thank you. Thank you, Kyle, and thank you to your group today. Appreciate it. Want to thank you folks for the opportunity for Zach and I to join your meeting today to give you a flavor of what we do here at Coface, our services and our products, and why clients choose us to be their partner for their credit management process, which is primarily to help them make smart, informed credit decisions, enhance their credit process, and monitor and mitigate risk and protect their balance sheet. A brief outline of who Coface is and what we do. So Coface is a major credit leader in the account receivable management space. We've been in this business for 75 years and currently have 100,000 clients in over 100 countries. We're a global company, and our mandate is to help clients navigate risk in uncertain and volatile times. And today's environment definitely matches that description for sure. Coface is a credit management company that also happens to insure receivables. With 75 million credit files under management ourselves and 75 more through associations and partnerships, we really are a database company that actually also happens to insure receivables. We are actually the largest commercial aggregator of credit information in the world at the present time. And that database gives our clients the ability to access current credit information on their customers to help them make smart, quick, educated decisions every day to help them grow safely and to mitigate risk for sure. We are actually a one-stop shop for all things credit. And with 69 offices throughout the world directly and partnerships in over 100, we can serve our clients anywhere in the world. Our principal products include trade credit insurance, account receivable insurance, business information products, which include credit reports, customized credit opinions, and debtor risk assessment, DRA. And we also are active on the international stage in debt collection. We can collect money anywhere in the world that we are active in. And we also do some single risk coverage as well, meaning that if you have a concentration on a single buyer that you need protection with to help protect your balance sheet to cover off that concentration, or if you are undertaking a major project in a country outside of Canada and you need some help there to protect that risk in the event of default, so you can possibly secure some additional financing from your lender, we can do that as well. So that's principally what we do.
Great. Thank you very much, Todd. And with that, I'm just going to invite Zach here to sort of provide some high-level perspective of where we see ourselves today.
Thanks, Kyle. Morning, everyone. Thank you for joining us here today. So for us in Canada right now, I think we're in a very volatile and uncertain time. There's a lot of decisions that people are making without knowing what the certainty level is. In past we knew we had an idea of what the environment looked like, whether it was some economic downtrend, but now we have some other variables that are coming into place, like tariffs, which are delaying purchasing, which are changing supply chains. We have reciprocal tariffs, which again create more concerns because we need to focus on not only what our government is focusing on, but what others are. Now, for beginning of March, this was a lot more erratic. We didn't know which direction it was going. You know, the example, I think, of the electricity from Ontario to the US with a 25% tariff that disappeared within 12 hours was pretty unnerving to a lot of people. It slowed down a little bit, and the situation remains dynamic with many groups now having conversations, but that uncertainty of what's going to happen next, I think, lingers over all of us. So for us, does that impact, is the tariff impact, which is political? Is it an economic impact because of the current situation? Or are there other aspects where you have Canada being, the average consumer being highly leveraged, having concerns with I think it's about 50% of mortgages coming up for renewal in 25 and 26. So where is the Bank of Canada going to adjust their rates? What is the US consumer going to do? What are the impacts of potential agreements happening, whether it's the USMCA, the Canadian elections, which are happening at the end of this month, will tell a different direction that Canada may move in from a political perspective, or it might say the same. We don't know. So at this point in time, there is a lot of uncertainty that has ultimately come into this environment, which is causing all decisions made by a company to be more scrutinized, to be in a better, to think longer term, but not having that ability to project long term because of the fluctuations that continue on what seems to be a daily basis. So just to give everybody an idea, for us, this has challenged us because we oversee a very large portion of debtors. As Todd mentioned, we have a very significant group of debtors globally that we as a group at Coface oversee. So for the Canadian, as an example, for the Canadian team here, our team's role is to oversee all debtors in Canada as we monitor the exposure for our portfolio. So this is not just taking decisions and saying we believe that a company is okay as of today. Our goal is to say this is our view of the company today, and continue aggregating our resources and reviewing that debtor, not just today, but in 3 months, 6 months, 12 months into the future, to see what trends we anticipate, where there could be deterioration or improvements. Our goal is to be a credit advisor. So it's be a partnership where we enhance our policyholders to help them and to aggregate information that may not be easily available. We know publicly traded companies and rated entities are easy to see, but for us, we have different information from our policyholders locally and globally about information on smaller and medium-sized enterprises that bring that information to us, which is not as easily able to be available to everyone. So in doing this, having discussions with them, we try to provide a better aspect, not only at a micro level, but also at that macro level. And to give everybody an idea of where our focus is right now in our portfolio, we're looking at a few main sectors, and the list seems to keep expanding as time goes on. The first sector, which we've really focused on, centers around the steel industry. With the tariffs in steel, with the cyclical nature of the goods, we've seen a decline in the overall commodity price since 2022, which has put an impact on a lot of companies. You may look at names like Stelco, which was acquired by a US company recently. You have Algoma Steel. You have many other groups. And even in the UK, there are some concerns with some companies who are losing with foreign ownership, who have now are talking about potential closings or bankruptcies. You have Germany because of having issues with ThyssenKrupp looking to lay off a lot of people because of energy costs. So there's a lot of concerns in the steel industry. And at the same time, steel predominantly feeds into automotive and construction. And we know the construction industry is struggling. We're seeing less developments. The largest number of bankruptcies that we are seeing are in the construction space. And the automotive potentially be with the tariffs and international automobiles being shipped here, having tariffs, it complicates the scenario whether they move to the US or they stay within Canada. So this is one area we're focused on. We're also focused in the transport industry, with goods not being as easily sold between Canada and the US, our largest trading partner. There have been articles that come out and have said about 60% of transportation is actually transborder. Sorry, and when I say transportation, I mean trucking. If trucking already has thin margins, there's a lot of companies that leverage themselves during 2021 and 2022 to take advantage of the high rates of freight, which have now come down materially. So you have thin margins, increased costs for labor, fuel, and now potentially if 60% or any part of that 60% were to drop, you now have more freight for less demand, which becomes concerning. There's many different areas we focus on. I want to just focus on these two, but I also want to open up and make sure we have time for everyone here. If there's questions that you have, that I'd be happy to answer or go a little bit deeper into. But I want to make this session about everybody who's made their time available today.
Super, and thank you, Zach. And while we wait for some questions to roll in here, I understand that's obviously a very bleak reality that we're currently sitting in. And if we were sitting outside of this current time frame, I think this discussion is still highly valuable at that leadership team level. And we work with private businesses exclusively on our end. So, your team has access to this sort of unique data that's not publicly available in the same way that public companies are. But if you were sort of the executive team of a company, and let's just focus on the buyer side, if you were sitting at your leadership team level within a company, you're trying to assess the default risk or just the overall risk of your buyer network, what would you sort of suggest doing? Where would you start?
It's difficult when you have that for bigger companies that have robust credit procedures in place and are open and understand the process of sharing information, whether it's trade references, credit reports, or financials. It's a lot easier. For the smaller companies, you typically need to go a little bit deeper. Whether you might start them out on cash on demand, but extending credit is always a risk that you're at. We've actually seen it in the last couple of years where we've had a number of companies who have said, we've been dealing with this company for 10, 20 years, and then they've gone bankrupt. Or they've seen specific companies who they thought because they were getting government funding or they were getting specific benefits from larger groups that this made them stable when they have retreated. We've had specific companies that had one debtor. All they did was they sold to one of the OEMs in the auto industry, and then they pulled the contract from them. And now the business and the suppliers who are involved are stuck with inventory, or now have to find a different way of selling the business. They have no revenue. We have seen, I think one of the big ones that we saw recently was Lion Electric. This was an electric bus company out of Quebec who kept getting propped up by the Quebec government. And a lot of the feedback that we got was the company is publicly traded. They're supported by the Quebec government. We saw the trends, we saw the cash burn, and we advised numerous clients there is a concern. And unfortunately, some of the groups didn't listen to us, and that was the case. Sorry, go back to your original question. For the smaller groups, we want to be in a position where we provide risk ratings. We want to have risk ratings on companies. We want to search information. So for us, we look through credit reports. We look at the positioning of the company. Who are their partners? What does their competition look like? Do they own the buildings or do they rent it? What's the financial status of the owners of the company? What links do they have to potential international companies? And we try and build, at the end of the day, a credit story on the individual group. So we really do invest the time to make an assessment on these smaller debtors. And this includes claims information, or we also like to speak with our policyholders to get additional information. So because we have multiple companies who ask for credit on one debtor, we have different viewpoints of their needs, what the interaction is, and we also have an analyst group who can contact them directly through a non-disclosure to try and get financial statements. So for us, it's really about building that story, investing the time. And for us, we stand behind the decisions we take so that if we make a mistake in our assessment, we indemnify it. So we also have that mindset that we're a partner and we're taking the same risk you are.
Yeah, here inside. So you actually landed on some pretty nice, I'd say, nuggets of insight there of how you could create your own credit risk story to some degree of reliability, but definitely not then identify or transfer the risk to a partner. And I just took down some of those notes there, like just checking into the status of the owner and whether they own their properties or they're leasing if they have large debt already. and then proactively changing some of those credit terms. But I just heard you right at the end there, really sharing about how much work your team is doing, because really your profitability comes in from getting it right. And so there's the benefit of transferring that risk off as well. We do have a question too around its inventory buffering specific to this trade war and supply chain slowdowns and additional new costs. Now, maybe you already have an answer or way to answer this question, because I'm sure you assess inventory if possible to some level to see if it's good inventory or not. Maybe that's not part of your assessment, but what would you do at this point to strategically plan for terms and having an inventory buffer through that whole supply chain cycle?
So for us on our side, our assessment is on the business itself, and the product that we insure is accounts receivable. So it is a little bit outside the scope from where we plan for the inventory component. I think at the end of the day, it's always difficult to predict inventory, because there can be bulges in purchases. There can be one-time orders depending on how things go. In terms of inventory, I think it comes down to understanding who you're selling to at the end of the day. We know that the tariffs at the end of the day have an impact, but it is a monetary impact. And by understanding where you are from a competitive perspective, if you are their sole supplier, what that relationship looks like, is the local market cheaper, more expensive? Do you have a unique product which is needed to go into the market? All these variables differentiate you and how much inventory you need to hold. At the end of the day, you need to hold as much inventory that allows you to be liquid, to be in a position that you can operate quickly and get in your model. If it's just in time, your process, it's much different than if you are selling, let's say, winter coats, which you have to accumulate all the inventory at one time and sell it at one time of the year. So I think it's a fine balancing act of really understanding what your debtors and what your market are seeing, what the feedback is, and then finding a way to plan accordingly and have that collaboration with your debtors and that constant contact to really understand what their needs are, so you can plan accordingly. If without that, it becomes very difficult when it's just one-off sales, or you don't have that type of relationship. For us, we're trying to give that insights into the strength of the company and how we believe they can hold up. So if you are selling to them, we want to make sure that you get paid back. They will be stable. They aren't hoarding inventory. They aren't tying up their liquidity, which ultimately they need. And that's how we try and balance everything, by having those conversations with the groups, making those assessments, so that you can properly forecast instead of hoping that they sell and do a paid when paid at the end of the day.
On that, so then coming back onto the debtors side there, where I'm thinking even at the municipal or government levels, there's a chance there's slowdowns. I mean, that there's in how much they're going to be spending, and some of our clients, and I know many, will serve the municipal or government layers of agency. And so, because usually that's the safe haven when the private sector slows down, government starts kind of filling the gap. But we might be having sort of both come in here, where even those safe buyers they're not going to default potentially, but they will slow down. So the question that I have is more about when you are looking at providing insurance or extending credit to a business, how, when you're looking at it from, like, let's say the purchaser of the insurance side, like, what red flags or things do you see when there's like a high concentration on dependency on like a single debtor? Like, what would be the is there any red flags that go off on that front, if that makes sense?
Yeah, no, it does. Concentration risk is something we definitely look into. When there's concentration risk in place, this can substantially affect a company. An example of this that again, it's public, is Algoma Steel. It's a publicly traded steel company out of Sault Ste. Marie. This group, the CEO, when the steel tariffs came in, he came on BNN and various different groups and said, we are not shipping to the US again, despite the fact that 60% of all sales were to the US. This is a very material amount of revenue, which the company, who is also investing into upgrading basically their boiler system in place. So they have significant capital expenditures. They've lost 60% of their revenue. They're also not, from that perspective, the tariffs make them uncompetitive to go into the States. This is very material from our perspective, and we are waiting for the Q1 results to come out to see what the true effect of this decline is. Because most of these companies, if the sales go down, your fixed overhead isn't going down to the same extent unless you're doing layoffs or you have found a way to make the majority of your expenses variable. And because of this, it creates a challenge. So for us, when we see concentration risk, it depends on the level. 10% is material, but there's still some flexibility. But as you start increasing that amount, your positioning or a negative effect, whether it's internal or exogenous, allows the business to be materially impacted and can create that immediate shock, which could force them to delay payments, which could force them to reassess their strategy and make those challenges for their suppliers very quickly, as well as their debtors.
And I know you're primarily, well, you're in the debtor side, and I know I keep trying to turn this into supply chain as well, just because given in a lot of private businesses, depending on how large the private business is, they can rely pretty much 95% on a single supplier. I think, and a lot of those suppliers are not naturally like local. They could be anywhere else in the world. We're potentially going through a period now where, again, we have a stable economy compared to a lot of places around the world. And it's difficult to sort of see what the risk of that supplier is. And if that supplier was all of a sudden just pulled out of the supply chain, I would imagine it would just basically put the company at huge risk as well. So I know you were sharing before about things you could do to check out the quality of your buyers or your debtors. But do you have anything just from a recommendation perspective, from a risk mitigation, to sort of check out the validity or stability of your supplier, especially if you did have like that one main supplier?
From our perspective, I mean, for us, since we evaluate companies, we look at companies from both sides. Now, our product specifically is tailored to the debtors and the receivables, but the same principles can be easily applied to the supply side. And as Todd mentioned, if you have that international supplier, it becomes a little bit more challenging. And one of the advantages we have is we have on-the-ground individuals who are doing these assessments. So we do have, as much as we have the information or the credit insurance side, we also have an information product, which uses the same information, the same analysis to help our policyholders with that supply chain component. At the end of the day, the way I look at it is I look at business risk, and whether they fall on the supplier side or the debtor side, there isn't a difference. You want to make sure that whoever is involved and whoever you're partnered with is reliable, is stable, and you have those assessments where you have continual communication with these groups to ensure that process continues. Because as you said, Kyle, I think you're spot on. If something does happen to that one supplier, things change. We've seen it. I think we've seen it very quickly with China and the US putting basically 100+% tariffs on each other. We're either going to see some people move to the US and relocate so that they don't pay the tariffs, or you may see that some companies in China might open up in neighboring countries like Vietnam to avoid those tariffs as well. There's the same idea that you might have China shipping to Canada and then Canada shipping to the US for a different level of tariffs. And I think that's where there is that uncertainty at the end of the day, that we just have to evaluate the business. We have to evaluate the macro environment, because there are good businesses in a more challenging country or challenging industry. And by having that understanding, communication, and assessment on both sides, we'll be able to best position ourselves for success.
Great, thank you. And then because I'd love to sort of have you guys share about how to introduce themselves to a trade credit partner if that hasn't been something that a business has thought about to date. But just before we do you have any insight into what banks are thinking these days and other lending bodies around their appetite for lending? Because it's one of those stop gaps, or are they providing any temporary additional bulges to operating lines? Like, are you seeing anything on that front?
Todd, I'll let you speak on this since you're closer
Sure.
to many of the bankers.
Yeah, so right now we're seeing an environment where banks are looking at operational results of their clients very closely. And in some cases, they're, asking them for additional security in the form of account receivable insurance for about 4 or 5 years there, just before the pandemic. And then during the pandemic, especially when there was government support all over the place, the banks weren't asking for much security by way of account receivable insurance and insurance on their clients' receivables to support, those risks. But they're definitely back in the market right now, and we're seeing a lot of prospects that are coming to us by way of bank referral, looking for account receivable insurance because the bank is requiring it as part of their covenant to support their operating line. So the banks are definitely back in the market and getting their clients to purchase account receivable insurance for sure.
So that's on the oh, Zach, were you going to share there?
Yeah, I was going to say the other thing that we're also seeing, just in addition to what Todd's saying, is on the debtor side, is we're seeing a lot of companies coming up for refinancing. And because of this refinancing, we are seeing more challenging positions of companies. So to Todd's point, if the banks are getting the financial information, they're seeing the challenges, and they may not have been as aggressive when it came to some of whether it's usually when they're domestic, they're a little bit more comfortable, but when they're shipping to the US or internationally, a lot of the banks are much more conservative. And if they're starting to be more conservative, the value of not just the receivables, but the inventory, the equipment, the real estate, some cases the intangibles, they're now reevaluating how much they actually want to lend against these assets because it isn't the same borrowing base anymore. And that's, I think, what the challenging piece is that they are seeing those trends, and because they also have access to these financial statements, they're looking not only at the one division, which is lending. I think they're also looking at all their other divisions where before they were being propped up by the subprime car loans fees that were being made. The mortgages are starting to drop, especially in the commercial mortgage space, which is now having problems. So and typically the bank doesn't do things individually, they do it all at once. I believe this is why we're all seeing this, is that there's tightening across the board from a credit perspective because they're trying to mitigate losses. You're starting to see the international requirements of Basel III and eventually Basel IV coming out. They're going to need to start shoring up some of their capital requirements, which ultimately tightens everything. And they're looking to, the way I look at banks is they like to charge fees but have no risk. So they're also trying to find different ways to do that, to offload that risk. And we're starting to see more and more of it, and we're starting to see even in the financials that we get that there are, as Todd said, breaches of covenant. There are some concerns. We are seeing maturity dates. We haven't seen too many term outs, but that's because the bank understands that they want to get their money back. And when you start terming out in a challenging environment, it becomes more difficult to get their money back. So they want to work with groups, but there's a lot of, Todd, I think you were the one who's saying this, a lot of people are moving to special loans to help with the renegotiation of the outstanding balances.
Yeah, we're seeing some of that. What we're also seeing as well is companies that are coming to us and asking for a change in the loss payee on their programs as well. Like they're changing lenders, and typically before we see that, there's a interruption in premium payments. We are seeing a number of policyholders right now that it's kind of ironic that we are insuring them against the payment, of their clients paying them, a default. They're actually defaulting on their premium payments to us. And that's always a foreshadowing event of they're having cash flow problems. And now they got to start, they go and they start shopping their lending facility to other banks. And with that then comes, the request for change in the lost payee name. So yeah, there's definitely a lot of movement in the operating line space of banks right now, for sure.
It's an interesting insight and perspective you have, and I know you shared sort of that reactive case for why trade credit, makes sense because it's required as part of signing a new agreement. But just give you a chance, like, what is the proactive business case? And I get we're in a time of higher uncertainty, right? So, like, let's just pretend we're just having this conversation, and it's a different time with less uncertainty and less risk. But like, what is the proactive business case for trade credit insurance, and when should people or businesses start considering it as part of their business planning?
Yeah, so that's a very good question. Thank you for that. So, I mean, in my humble opinion, if I sat on the other side of the desk and was a business owner or an entrepreneur, I would be looking at account receivable insurance as soon as it was economically viable. In that case, if we have clients that have sales, they can say in the $2 million range, and with our minimum premium, they can make that work. They get a number of advantages, through account receivable insurance. Number one is they have balance sheet protection in the event that they have a client become insolvent and can't pay them. We're going to indemnify them up to the insured value and protect their balance sheet so that loss does not hurt them primarily. Second thing that we do is that we provide them with past due protection. So they have a client who's in business still but not paying, they're having cash flow problems. So we can act as a negotiator, as a debt collector, to come in as a neutral party and help that buyer arrange some form of payment plan with our client, their supplier, to help them get over the hump of having this outstanding debt. So we definitely act as a collection agency, and as a neutral party, we don't disrupt the relationship so much. And we try to take the emotion out of that situation, for sure. That's another benefit. The third is the credit information, access to credit data. As Zach said earlier, I mean, we are an account receivable insurance company for sure, but primarily we're a database company. So we give our clients access to our database by way of an online tool called Coface, which 75 million files of our own, 150 million, globally through partnerships, where they can collect a credit score on a buyer pretty much anywhere in the world, and have an underwriter provide them with an opinion on the creditworthiness on that buyer by way of an insured limit. And once that's put in place, the client can trade up to that limit at any time and always be insured. But at the same time, we're monitoring that buyer for them as well, so that in the event that we receive information that leads us to believe that the credit quality has changed, we update the client immediately. So now they're armed with the latest piece of credit data to help them with the next order that comes in to make a smart decision on that. And then, finally, the policy helps them negotiate a stronger lending agreement, borrowing agreement with their bank, and it really helps them to grow safely. Most CFOs that I know that use this program use it to identify their better clients quickly, and then provide more marketing expertise and efforts to those clients to grow with clients that they know that are good buyers. Most times, if this product is used properly, the return on investment is as much as 300%. And I know some folks don't probably think that's a bit, outlandish, but the math is pretty simple. You can get there. It's a great investment.
And
Zach.
Sorry, Kyle. Just to jump in to Todd's point, I before I joined Coface, I worked for an asset-based lender, and we actually used credit insurance. It was one of the backbones of what we had, and we used to call it the belt and suspenders approach. That despite our credit risk underwriting approach and how we looked at it, we still wanted to sleep at night. And it was, we could be as good as we could be. We wanted to have this product in place because we anybody can pull an Equifax, a D&B report and do an analysis. But to have someone in the background who has additional information, who can come in, make the analysis, and potentially find information that we didn't have at our size really made a difference. And this helped us get additional financing. And to give you an idea, when I started, we were about $6 million in assets under management. I know today the group is north of $2 billion. And this is because, as Todd said, when you start getting additional capital, because the banks feel more comfortable in your assessment, in your partners, the risk sharing that's in place, more people will typically come to the table because you have that stability and foundation in place.
And yeah, what I was going to add inside of that too is like one of the things we advocate for is sustainable growth and sustainable growth planning. And and what Todd shared as well is the idea that most businesses naturally are chasing sales. They're just chasing growth because they want to continue to grow, and especially if you have salespeople out there growing. But the idea that there's inside of the assessment or the risk assessment that there's like sort of a cap of how much you would recommend allowing someone to purchase from you is kind of flipping the whole business on its head and saying, hey, you could sell more, but it's gonna put that AR at that sort of more higher significant risk. So I just like that whole way of thinking about the business. If a business is fortunate enough to be in a position where, wow, we're producing, we can't make production enough to satisfy our buyers, we get to now select our buyer pool and shape it so it's diversified and risk adverse. That sounds really a really great place to be coming from as a business too. Any final comments or anything you'd like to share? And then anybody else, if you have any final questions, feel free to pop them in here. But I'm not sure who would like to go first, Todd or Zach.
Yeah, I'll just make a point of a case that I'm working on presently. I think one thing that always amazes me about Coface is our reach and our ability to collect data anywhere in the world. So, for example, I have a prospect right now that has a buyer in Australia, and we didn't have enough financial information on that buyer to get comfortable with the risk to provide the limit that our client needs, or a company that's based in Alberta in the oil and gas space. So through our information team, we're able to reach out to the buyer in Australia, collect their most recent financial statements, income statement, balance sheet, and get a comfort level to afford a credit limit of $1.25 million. So now the supplier in Alberta has the ability to sell them up to that value with the notion that they are secured, and they can take that policy that we have to their bank and get borrowing and lending against that receivable because they now have it secured by Coface. They did not have that ability 2 weeks ago. Now they do. So I'm always amazed by our reach and our ability to provide a product that enables companies to grow with buyers anywhere in the world.
Thanks. And Zach?
For me, I just want to say thank you to everyone for joining. Todd and myself are always available. We always do like chatting in these forums. It's an interesting economic environment, and we love the opportunity to hear from all of you, because I get tired of hearing my own voice from time to time. So it's always nice to learn from other experts in the field. So if you have any questions or you'd like to discuss anything further with Todd or myself, we would gladly welcome the opportunity, and we hope the best for everyone in these more challenging times.
And thank you both very much for giving of your time today, and especially during this heightened period we're in. I'd share the one big sort of takeaway or new concept that I've sort of taken for myself from here is the idea of building these credit stories of your buyers and your suppliers as well. And so an invitation beyond the opportunity to reach out and learn more about this type of product and service from Todd or Zach is just at the leadership team level, sit there and see, can we build a compelling story of credit that we're making the right business decisions for our business today, for our buyers and suppliers. But on that, thank you both very much for your day, and have yourselves a lovely rest of it. Take care, everybody.
Bye-bye.
Everyone.